You may own a stock at $260, but you really should be analyzing it as if you owned it at $180. Now, this is a mistake I've seen investors make time and time again, and honestly, it is just painful to watch because it is the equivalent to being right at the finish line with victory and then fumbling. Now, it is not your fault though, because I've worked at Goldman Sachs, I worked at Capital Group, I helped direct billions of dollars of investment flow, and I'm an investment advisor, and I've never seen this concept explained the way we are going to talk about it today. And that is how to figure in taxes into your investing. Now, this is of course all educational, but it is really important that you get the right education so you can apply it to your actual investing. Now, let us say you're in the position that you did your research right, you bought a stock, you held it for a long time, and now it is up so much, you can't really justify the valuation anymore, and you're trying to figure out whether or not you should sell it. What is kind of keeping you from selling it though, is the fact that you know you have this large tax bill. If you're looking at federal income tax brackets on capital gains, you could be paying up to 20%, depending on what state you live in. If you live in California, for instance, that could be as high as another 13.3%. Then you also have the net investment tax of another 3.8%. All in, you could be looking at, around 37+%, depending on what state you live in and your own individual tax situation. That is a lot of money to be paying in taxes, especially as you look at your portfolio and you know that you're going to watch it drop a lot in value. Now, that is the psychological reason. Most people are kind of aware of that. That is not what we are going to hit on much in this video. But you should just know that a lot of investors say one of their biggest mistakes is thinking too much about taxes and paying taxes, and that preventing them from selling a position they knew it was time to move on from. And so just be aware of that. If you're thinking a lot about why you don't want to sell a stock and it's because you don't want to pay the taxes, that's generally speaking not a great reason to keep holding a stock. And so just be aware of that. But what I want to talk about today is how to actually analyze that and go a step deeper. Now, about 12 years ago or so, I bought some shares in Apple. I was looking today at my cost basis of some of those shares, and it was $15 a share. Now today though, Apple is around $260. That means in every share I own, I have an embedded gain of about $245. Now, yes, it's a nice problem to have, but once again, if you do go and sell that, roughly speaking, for simple math, let's say that the government is going to take a third of that money. And so this is how you should think about this. With a $260 stock price, today's stock price, a $15 cost basis, and a $245 embedded gain, that means that at a roughly 33% tax rate, $80 of that stock you own is going to the government. Said differently, the government is giving me a deferred loan at 0% interest for $80 on every share of Apple I own. And that is because if I go to sell that share of Apple, I will have to repay that loan. I will have to pay the government the taxes. And so you could think about, if you want, this is a sort of form of leverage in your investment, because this is money that does not belong to you in a way. The government has a legal claim to it. And if you ever sell your position, you will have to pay that tax. And so if you are looking at Apple, let's say today, at a $260 stock price, and you had that $15 cost basis and roughly a 33% tax rate, and since if you sell it today, you'll have to pay $80 in tax, it's kind of like you really only own it at $180. And once again, that is because the fact that the money you will pay out to the government, you get to keep in this position interest-free, which sort of leverages your sort of return. And so you should still think about Apple at today's current valuation, but let's say that you only believe it can, just making up a number here, your expected return is 7% or 6% going forward. Because you have this kind of borrowed money in this position that will go away if you sell it, in a sense, it's really like your actual position is going to be 10% or 11% return. And that is because of the gains you're going to get, or at least 2/3 of them, can be attributed to your $180 cost basis instead of the $260. And now, if this is getting a little complicated, don't worry. I just wanted to explain the sort of idea behind it. All you kind of need to know as an investor, though, is that when you do have this big gain, you could just multiply it by your expected tax on that. And that is basically how much money you have interest-free invested in this position. Then you just need to understand that if you go and sell the stock, you will be losing that money. And so what you need to understand is that when a stock has a big gain embedded in it, because of the fact that there are taxes, you should be willing to actually accept a lower expected return. And so in this example with Apple, you have a $260 stock price. That is our current stock price. Let's say you expect it to return 7% or so going forward. That would actually be the equivalent to getting a new stock at $180 that will earn 10%. And that is because once you pay that tax, you have less money left. And so you need the smaller amount of money to earn more money in order for it to be an apples to apples return. And so, no pun intended there. And so if you have a 7% return on a $260 stock, that is the same mathematically as getting a 10% return on a $180 stock. And so that is just one way you should be thinking about it. Think about what you expect your tax to be in this position, and think of that as a sort of interest-free loan. And if you're willing to forego that loan, it should only be because it really, really is overvalued, or you have a much better, sort of opportunity elsewhere. And that is why it also makes sense if something's just a little overvalued and you have a big capital gains embedded to not sell it. However, if it is really overvalued and you're hanging on to it because you just want to avoid the tax, that tends to not be the smartest thing. But that is also why you often should not sell a stock purely on valuation. Some exceptions if valuations truly are absurd, but that is actually pretty rare. Usually it's the case that something's expensive, but it's not what I would call a Godfather offer, which is an offer that is so good you cannot refuse it. Usually it's kind of in this middle gray area where you're like, I would never buy it at this price. But okay, if everything kind of goes well for them, then I could kind of see it still working. And then I have these embedded capital gain taxes I'll have to pay. And once I think about those and the fact that if I have to reinvest that money, I have much less money, it kind of becomes a tougher decision to make. And so if you want more clarity around when the right time to sell a stock is, make sure you watch this video here. And if you want to learn more about investing, make sure you hit subscribe and like. And if you have any questions, drop them in the comments below.